This video, I want to talk about how government fiscal policy affects stock market investing, how government fiscal policy affects or impacts or influences stock market investing. Fiscal policy, through government spending and taxation significantly affects the overall performance of the stock market. So here is how it influences investment decisions. I want to highlight how fiscal policy influences investment decisions. Number one is government spending and economic growth. Government spending and economic growth. When we talk about government spending, we are considering expansionary policy as well as contractionary policy. Expansionary as well as contractionary policy. So expansionary policy actually refers to higher spending, or tax cuts, higher spending or uh, you know, uh, tax cuts, how it boosts demands, encouraging economic growth and improving corporate earnings, often leading to positive market performance. Usually, whenever there's a cut in the tax rates, individual will have more residual income to spend, and the more income they have to spend, that would boost corporate performance or corporate revenue. And as our corporate revenue increases, it will impact the bottom line, and by so doing, profitability and earning per share of company will actually obtain a boost. It will increase substantially. When it comes to contractionary policy, that's spending cuts or tax increase. In the case where there is tax increases, this can slow down growth, reducing demands and negatively impacting corporate profits and stock prices. Whatsoever would increase demands for goods and services definitely is going to affect corporate performance, and that will generally impact profits. And whenever profits are down, you discover that stock prices will be affected negatively. Number two is impact on interest rates. Impact on interest rate. In this case, we talk about increased borrowing and debt. Increased borrowing and debt, that's under impacts on interest rates. So high government borrowing to finance expenditure or spending can push up interest rates. By so doing, it makes capital more expensive for businesses and possibly dampening stock market prices. Whenever businesses cannot borrow at a cheaper rates, discover that it will dampen expansion, it will dampen growth, it will dampen overall company activities, and that would affect stock prices negatively. It will compel, it will it will cause stock prices to go down. Not only that, there is this particular inflation concerns. Inflation concerns. So in this case, rising debts or spending can spike inflation fear. And people, tend to spend too much. It would tend to heighten inflation, leading to higher interest rates, which typically hurts stock markets, especially growth stock. Whenever there's an increase in interest rate, it will certainly affect growth stocks in the stock markets. All right. So number three here is sector-specific impact. Sector-specific impact. So in this case, we talk about targeted government spending, targeted government spending. Investment in infrastructure, energy or other sectors can boost specific industries, improving stock performance in those core sectors. If the government is spending, let's say, on construction, like road construction. Companies in the construction sector of the stock market will stand to benefit positively, particularly if they're engaged, in the contract, in executing the contract itself. So they stand to benefit, positively. Not only that, there's this tax incentives, tax breaks for industries like technology or in renewable energy can increase company profitability, driving up stock prices in those areas. Areas that are favored by government policy, companies that are favored by, maybe they have tax incentive. You discover that that would then lead to an overall growth in both the top and the bottom line, and the stock prices of those companies would then uh, perform relatively well. Number four is government stimulus packages. This is a very important fiscal policy that would affect the stock markets, to a tremendous degree. We have stimulus payments during economic downturns. Government issued payments can increase disposable income and spur consumption, benefiting sectors like consumer goods and services. We all are aware of what happened during the pandemic. The government paid out, a kind of, relief, and the relevant sectors benefited from people's disposable income. Not only that, we have what is called quantitative easing, QE, quantitative easing. Although a monetary policy tool, it's actually a monetary policy tool. It can increase liquidity in the markets, potentially rising, stock prices by boosting capital flow into financial markets. The more people have the way without to spend, the more they can boost investment in the market, in the stock markets, and the increased buying activities will certainly cause the stock prices to skyrocket, and then the stock market in general will benefit from this particular policy, that's quantitative easing. Please like this video and subscribe to this channel if not done that. That would then give me the incentive and the catalyst to keep on bringing contents of this nature to you. Number five is a long-term implication. The long-term implications of government fiscal policy. So in this case, there is this fiscal sustainability. So prolonged deficit spending, without sufficient revenue it may raise concerns about long-term economic stability, which could hurt investor sentiments and market performance. And not only that, there is a policy uncertainty. In a case where we encounter changes in fiscal policy, especially in politically unstable environment, this can introduce uncertainty, leading to market volatility, as investors adjust their expectation to the economic environment, in line with the economic environment. And there's always a long-term implication of fiscal policy on the performance of the stock market. Number six is investor sentiment and confidence. Investor sentiment and confidence. So we have political stability as well as market reactions. Political stability and market reaction. When it comes to political stability, a government with a clear, sound fiscal policy instills confidence in investors, fostering stock market growth. Once there's investors have the confidence to invest, definitely it would lead to a growth in the overall performance of the stock markets. It will foster growth, in the market. And not only that, there's this market reaction. As a fiscal policy can, this change in fiscal policies such as a new tax laws or budget proposals can cause market volatility, as investors react to anticipated economic impact of those policies. And so, whether we like it or not, the government behavior, government fiscal policies will certainly have an impact in the market, in the stock market, because both institutions tend to go hand in hand. The performance of one will affect the other. The performance of the other will equally affect, the other one as well. So this is how fiscal policy affects the performance of the stock markets in general.